I wanted to talk through this chart that Ben Carlson from Ritholtz Wealth Management put together that kind of shows how each asset class has performed over the past decade. So thanks, Ben, for putting this together. And I wanted to break down some things that I'm seeing. So 2022, as most people know, closed as the worst year for stocks dating back to 2008 in the midst of the Great Recession, in combination with the worst year in mid to long term bonds going all the way back to the 1970s. So, with both stocks and bonds performing poorly in 2022, there's nowhere to hide. In fact, if we look at a traditional 60 portfolio, 60/40 equities to bonds portfolio, this was the fourth worst 12-month period in the history of the United States. Fourth only to two of those periods being in the midst of the Great Depression, one other being in the 1970s. We often see some of the trends that I'm looking for when we're looking into what do we expect to do well up in the upcoming year. One of the common trends we see is that areas of the market that do the most poorly one year tend to do the best the following year, and vice versa. This doesn't always happen, but we do often see that pattern. In fact, looking at REITs or real estate, the dark blue squares did the best in 2021 after being in the toilet bowl the year before, and then bouncing back to 2022, shot back down and took the crown for the worst performing asset class of the year. My final other takeaway is that it's been essentially a lost decade for foreign stocks, specifically emerging markets. Emerging markets, that yellow square, if we look at the far right column, the yellow box, essentially had zero returns for a whole 10-year period. What we know, again, is that emerging markets significantly outperformed US stock markets for the first decade of the 2000s, and this ended up flipping on its head in the 2010s decade. With all that said, the only thing we know is that nobody knows anything. It's the reason why us financial advisors preach diversification and why we recommend owning areas of the market that have done horrendously in the past. Because we never know when it will flip, and we do know that it eventually will flip. So we want to be ready when it does. Diversification, again, just means that we're always going to be wrong in some areas, like holding emerging markets for the past 10 years. But it also means doing better when things aren't doing as well. If we hold areas that are doing well and areas that are doing poorly, we're going to keep our returns more consistent and steady ride throughout the time. We also are hedging our bets against all those other things. So let me know what questions you have. I'd love to hear some feedback on that. Thanks.